Mortgage rates jumped from 6.67 to 6.85 this week. And if you looked at the economic calendar, that probably doesn't make much sense. There was no major inflation report, no Fed meeting, and no blockbuster data. So what actually happened? The answer is that this wasn't really a housing story. It was more of a bond market story. Throughout the week, oil prices surged. Geopolitical tensions in the Middle East intensified, and at the same time, there was new tariff announcements added, another layer of inflation concern. When investors start thinking inflation could stick around longer than expected, they demand higher returns on US Treasury bonds. As Treasury yields rise, mortgage-backed securities typically weaken. And that's exactly what we saw this week. Mortgage rates moved higher right along with them. Here's the part that nobody is talking about. This is the interesting part. Despite higher mortgage rates, purchase mortgage applications actually rose this week. And that's a great reminder that serious buyers aren't waiting for the perfect interest rate. They're making decisions based on life, family, and opportunity. And while affordability is still incredibly challenging, today's homeowner remains in a very, very strong position. The average homeowner right now has more than $311,000 in equity, giving the housing market a much stronger foundation than we've seen in previous cycles. So here's the one thing that everyone missed this week. Mortgage rates didn't move higher because housing suddenly got weaker. They moved higher because financial markets became more concerned about inflation sticking around longer than expected. Understanding why rates move is just as important as knowing where they are. I'll continue watching oil prices, inflation expectations, and the bond market closely. If anything changes, I'll break it down in plain English. If you found this helpful, please like, subscribe, forward to anyone that is trying to make sense of today's mortgage market. Thank you.